thank you for joining us today as part of Chardan's crypto mini conference. Uh, Today would like to really jump in, start talking about the halving, your views there. But for the audience, do you think perhaps you could just introduce yourself?
Yeah, pleasure to meet everyone. My name is Asher Janut. I'm the CEO of Hut 8 and recently got put into the seat a little over a month ago.
Great, wonderful, Asher. So, I think that this is the first time we've seen Bitcoin reach new highs ahead of the halving. And as a result of that, industry views on what's going to happen next month with the halving in April have really evolved over the past 4 or 5 weeks. And in addition to that, we're seeing ETFs generating significant buying power. I mean, at the beginning of the year, we were anticipating somewhere between a 25 to 30% drop off in global hash following the halving. And now managements we're speaking to are calling for 10 to 15%. What's your viewpoint on that?
So price action has very much, I think, supported the mining space, right? If you talk to Bitcoin miners 60 days ago, I think people would have a very different perspective as today. With Bitcoin above $70,000, hash prices high right now as well. And so I think if you see it having affect basically Bitcoin miners, it'll be a lot less severe because with hash prices at 10 cents, I mean, you're back to 5-cent hash prices post halving, which is similar to where Bitcoin and hash prices were back when Bitcoin was at $30,000, right, or $35,000. And so I think because of that, you'll see less of a offtake in terms of difficulty on the market compared to what people would have thought earlier.
Yeah, that's right. And I guess to that point, many managements have been calling for, call it enhanced M&A activity, consolidation in the space when they thought that more miners would become unprofitable at the halving, right? So I guess what's your viewpoint on, call it M&A following the halving event?
I think it still will happen because at the end of the day, your revenues are still getting cut in half, even if you're still profitable. Some folks will be marginally profitable compared to coming offline because they aren't. For
Right.
states that weren't profitable, they probably wouldn't have been great M&A acquisitions on its own right? And so if it was a site, you have to look at the reasons why it would be interesting from an M&A perspective. It's, hey, you have an old site, we can go and invest more capital into it to make it more revitalized and newer site and have better energy management. That could be interesting from an M&A perspective. If it's you have older machines in an older site, we can come in, take over the facility, bring it up to kind of current standards and also add new generation efficient machines. That can be another reason for M&A. And so that's kind of one category of Bitcoin not having risen to above $70,000. The halving have happened in a lot of M&A activity. I think another lens of M&A is smaller players not being able to receive the capital that they need in order to grow, right? If you look back at 2021, you had companies raising tens of millions or hundreds of millions of dollars. Basically, over the course of a couple of months, you had dozens of companies raising capital. I think today capital will flow to the larger operators in the space who have a proven track record of execution. And so for that reason, operators who have built out sites that are subscale or built out facilities or companies may look to join a larger platform in order to kind of grow and achieve their aspirations. And so I think one is the inability to be competitive. And then the second is just joining a larger platform that has access to more capital to be able to grow.
Yeah, I think that's a really good point on the broader industry. And I guess as you're thinking about the broader industry, one theme that we've encountered over the past few weeks that's being talked about more are these, call it, pools of miners that are being operated by potentially nation states or other large players. As you're looking out over the broader market, I guess what percentage of hash do you think is controlled by public miners versus private? And how big do you think that, call it, pool of nation states, mining in Bitcoin is?
So the public miners in the US, I believe, account for a little under 30% of the global hash rate from the numbers that I received recently. Obviously, there are other public miners that are going public in other exchanges, like the UAE, for example, most recently. And so when we look at kind of the general demographic, about 35 to 40% of hash rate from the US. You have Kazakhstan, China, Russia, kind of within the top four, and then you're having more mining happening from the Middle East. You're having South America, Africa's coming up online as well. And so kind of directionally, our belief is that hash rate will continue to decentralize and kind of drive to the lowest cost of power. And you'll have nation states that are interested in basically using Bitcoin mining as an asset class to be able to manage basically energy consumption, right? So Middle East, extremely interesting because aside from kind of the 4 hot summer months where a lot of people are using air conditioning and high intensity of electricity, outside of the four months, the other 8 months, you're not even using 50% of the power availability. And so this asset class becomes really interesting compared to a manufacturing facility or other large consumptions of energy that would need to be online during the full period of time.
That's right. And, we're seeing an increased number of JVs and other types of investment in the Middle East for just that reason that you mentioned. And then I guess sticking with the broad view of the industry, what do you think happens in mining broadly over the next 5 years? What's the direction you think it's going toward? And how do you expect these companies to kind of generally evolve? What direction are you looking
I think scale will continue to matter. And from our perspective, scale comes down to the operation of the infrastructure and the assets itself, not necessarily the owning of the hash rate, right? And so I think if you have a couple of companies that own the majority of the hash rate of the network, that kind of goes against the Bitcoin thesis and ethos as well of mining and decentralizing and securitizing the network. And so from our perspective, that's why we have a diversified business of self-mining, managed services, and co-location/hosting. And it's about being able to increase scale both currently in North America, US, and Canada, and also globally by driving down the cost of mining so we're able to operate extremely efficiently. And I think it's going to be a couple of large-scale operators similar to you have in other more mature sectors that manage operations at extremely low cost. And then you'll have more decentralization of hash that I believe people will care more about as Bitcoin continues to grow more adoption.
Yeah, that's a good point, and I would agree with you there in broad terms. For investors that are less familiar with Hut, let's talk about your mining portfolio. What are your key locations? How are you thinking about energy, and what do you see as your competitive advantage when you look at the other public players?
Sure. So I think there's a misconception today. So we merged with Hut 8, and we have our earnings release on the 28th. That's going to come out. Actually, from a legal and financial perspective, US Bitcoin had acquired Hut 8, not vice versa. So I think that's going to be the first time for folks to really go through and look at the financials of the post-amalgamated company since the merger, which was done in the beginning of December. And so as a business today, we have over 10 facilities. We have a couple that we've announced that we're building right now. So we operate facilities across the US and across Canada. We have 5 data centers that we own. We own 4 power plant generation assets. And so as a business, we have a lot of breadth, but also depth in terms of scale. We manage right under 1,000 megawatts of infrastructure across the 3 verticals that we have today. And so the driver and thesis behind the merger was Hut 8 had Bitcoin that they had on their balance sheet. They were a large public company, and we had scale of operations, efficiency, and growth. And so that was the kind of driver of both companies coming together. I think we've had a leadership change recently, but the market hasn't really been able to see US Bitcoin as a private company operate the efficiency that it's able to drive. And so we're excited to continue to kind of execute and operate for shareholders and for the market to see in the quarters to come.
Yeah, excellent, exciting days ahead. I guess more broadly in the industry, we've seen asset-light business models pursue vertical integration. From an industry standpoint, do you think this
your strategy has to evolve based on market conditions and dynamics? And I'll give you an example. Back in 2021, we had acquired machines where we were very thoughtful to cap how much we would spend on the machine. So we would not spend more than $35 a terahash when the market was buying machines for $60 to $80 a terahash. And so we were very thoughtful in kind of how we spent. We built infrastructure. Then 2022 hit, kind of the bear cycle hit. You have the blow up of FTX, Celsius, and such. And during that period of time, we scaled from 87 megawatts to 730 megawatts under operation within a 4 to 5 month period. And so finding opportunities similar to when you're investing. You want to invest when the price is low and sell when the price is high. So I think similar to mining, you want to know when to invest when opportunities have high returns and the prices are low. And so, for example, at that moment in time, we had received additional machines from the manufacturer, and instead of building our own infrastructure and having self-mining, we actually put our machines with hosting partners, the generate partners at the time that we were operating for, because we felt like the capital had a much better ROI investing in distressed assets at the time. And now we're moving those machines through the Marathon acquisition to our self-mining site, because right now driving vertical integration and cost structure matters a lot more. And so I think for companies to be able to continue to scale and grow, it's understanding at what moment in time to invest capital into which part of the business, and the strategy has to evolve based on the market dynamics and what returns the best investment on every dollar spent.
Yeah, I think that's a very thoughtful response because as management, your primary responsibility is the allocation of capital and picking the point in the cycle when you want to do that, call it ahead of the halving, is probably the key generator of returns, regardless of energy price or anything like that, but rather, when you commit those dollars. So speaking of the ramp of exahash, I guess what are your plans? Where would you like to add? And also, there's been a lot of chatter about locking in forward contracts for rigs. What are your views there? How do you plan to drive this growth?
Yeah, so when we look at the markets today, our belief is that you'll see new generation of miners coming in Q3 and Q4 from all the major manufacturers. You're kind of at the end of the S21s that were announced last year. And so from our perspective, energy infrastructure will continue to be tight in the market, and you'll continue to have demand surge, both from Bitcoin mining, but also from other industries like traditional data centers, this massive kind of AI wave that we've seen in terms of demand and energy consumption, and other use cases as well. And so we have energy that we're very focused on in terms of locking in and building out infrastructure. And from a miner perspective, we are having deep discussions on the right time to kind of deploy capital. If you think about today, we have over $650 million of Bitcoin on our balance sheet based on where Bitcoin is trading today, right? If we were to sell that Bitcoin and buy machines for 17 bucks a terahash, I mean, that's over 38 exahash without having to dilute our shareholders by a single penny. Obviously, you have the cost of infrastructure on top of that as well. And so from our perspective, growth, when you already have scale, so today we manage over 27 exahash, we know how to operate, we know how to build sites, and we know how to operate and build at scale. And so I think the execution risk for our business to grow is severely lower than folks who are operating at the scale for the first time. And so for us, we are confident in our ability to execute, but to your point, want to be good stewards of capital and invest in the right moments in time, and would rather invest in the beginning of a new wave of efficiency and look at upgrades in the interim rather than spend all the money pre-halving, which is about a month away.
Yeah, that's right. I think we're of the same mind there. I guess as you're looking at your fleet, right, after you've committed capital, what kind of efficiency metrics are you looking at when you stack yourself against your peers to see, how well you're managing the rigs?
Yeah, so one of the metrics we look at is Bitcoin mined per exahash, right? And so how many Bitcoin did you mine per exahash, which kind of shows your uptime. I think it's not a pure metric, candidly, because in some of our sites, we actually don't mine Bitcoin to sell energy. And so that number may be artificially lower. So I think it's looking at Bitcoin mined per exahash, but on an adjusted basis on taking out the hours that you're curtailing on purpose. And then you can say how much money did we make during those periods of time. So that's one metric. Your cost to mine in Bitcoin, I think, is another metric. And again, everyone calculates that a little bit differently. I think thinking of it as an all-in cost to mine in Bitcoin, including kind of SG&A and your energy and transmission and delivery. I think a number that people care more about as well is kind of net income. I think right now there's a lot of focus on how much revenue, how much EBITDA can you drive, but people don't really think about the cost of that growth. And so how much are you actually spending on machines and infrastructure and acquisitions in order to actually get those numbers? And are you returning good return on that capital spent? So I think that is going to be a topic that's going to become more and more relevant. And just in general, we look at everything on a percentage level, right? What is our percentage of SG&A relative to revenue? Where are the different kind of margins across the different verticals that we have? And so today we have our self-mining fleet, we have a managed services fleet, we have a co-location business, we have a data center business. And so really understanding the margin profile at each and being able to kind of compare, because I think if you think about the business from a unit economic perspective, which is on every 1 exahash, how much Bitcoin do I make? How much profit do I make? And what's my overall return? You can basically scale that rather than just saying, I make more money, but it's like, okay, I make more money, but I also spent 5 times the amount in order to make more money, right? And I think that's really important and I think that's going to be when we merged with Hut 8, we kept the Hut 8 name, we kept the Hut 8 ticker. So really it seemed like, okay, it was a merger of equals, Hut 8 merged with us, but in the financials that we'll be having coming out, we were the accounting acquirer. And so the financials that you'll see is primarily US Bitcoin until the merger happened, then you'll have combined financials. And in that world, we were able to execute and deliver all of that on a little over $100 million of equity capital raised compared to billions of dollars.
No, it's certainly impressive. And when it comes to the efficiency metrics that you mentioned, I agree with you that even though there are some shortfalls in comparability, Bitcoin per exahash is probably the best way to do it. You just have to make sure that you can.
I think the three metrics are
Yeah,
Bitcoin per exahash, and ultimately, what is your profitability when including CapEx? Because if we have a miner that is not as efficient, but we're able to use our energy markets, we're able to use our software to underclock it to be able to drive margin out of it. It's how much money and how much return are we actually driving to shareholders? And so if I go and spend $100 million to grow versus the next person, how much am I able to return on that 100 million spent? And it's comparing things more apples to apples.
yeah, no, I think that's a very good point. So what's your view on hodling?
So we announced a new treasury strategy a couple of weeks ago, and we don't have a decommitment to having to hodl for the main reason that hodling is about how do you return value to shareholders. And currently, I mean, our stock is trading near kind of our hodl balance, and so we believe our cost of equity is extremely high. Shareholders are investing in us for growth because we're a smaller company that is growing the business and we're a growth stock. And so with that in mind, we want to figure out, number one, where are the best areas to deploy capital to drive the most shareholder return, most return on capital invested. But in order to drive that shareholder return, where can we pull that capital that we believe is the lowest cost of capital at every moment in time? And so when we look at where we can pull capital, it's raising equity, which we believe is expensive, raising corporate debt, which we don't think is the right moment in time to do based on the halving coming up in market volatility, being able to do project level financing, equity and debt, which we're very active in, that doesn't have kind of parent recourse. And then either selling the Bitcoin stack or being more strategic and looking at different option strategies on selling options to be able to pull money off of that Bitcoin stack and use it for working capital.
Very good. And then I guess just as a final thought, as we come to the end of our call it question session, there's been a lot of discussion in the industry about procuring owned hosting facilities, about self-mining, about vertical integration. And running parallel to that is this discussion that the call it appetite for increased AI computation power will create competition for hosting sites. I guess what are your thoughts there in general?
Yeah, so there's obviously an increase in AI and data center demand. There's very specific parameters on where you can locate an AI data center compared to a Bitcoin miner in regards to network connectivity and location to major hubs. And so I think there will be specific assets that have more demand and more buyers for that specific energy in that region, right? In places that we operate that are kind of more in West Texas or in the Panhandle, you don't really have a lot of those dynamics there. But I think over time, you'll have more use cases that come up, and that underlying infrastructure will be more valuable, and that demand will increase. And so I do believe you'll see increased demand, which is why we have the data center division. We announced our first purchase order of NVIDIA H100s back at the beginning of the year. And so we believe that that is a pillar of consumption of energy assets that will continue to evolve and grow. And our business is really owning and managing underlying energy infrastructure, and then being able to have different use cases that stack on top of it. And so AI and data centers are just one use case that we believe has very fruitful growth in that market as well.
Asher, thank you so much for joining us, and we hope to have you here again soon. I think that this has been a great use of time.
Thank you for the time. Appreciate it.
Cheers. Thanks.